In June of 1995, a 71-year-old retired lawyer walked into Harvard Law School and listed 25 ways your brain destroys your wealth. He did not have a slide deck. He did not have a PhD in psychology. He had spent 4 decades watching investors blow themselves up, and he had decided to name the patterns out loud, in plain English, in front of a room of people trained to think for a living. The speech was called Psychology of Human Misjudgment. The man was Charlie Munger. The talk has outlived every business book published that decade. Tonight we are going to walk through 5 of the 25 errors Munger named, the 5 that, by his own count, cost investors more money than the other 20 combined. We are going to call this architecture the 5 misjudgments. Reward and punishment. Liking and loving. Doubt-Avoidance. Inconsistency-Avoidance. Social proof. 5 errors. 1 brain. The map is the start of the cure. If you have ever held a stock past the point where the thesis was broken, drop a 1 in the comments. That is it. Just a 1. And if any of this is starting to sound familiar, hit like. The like button is what tells the algorithm to send this to the next person sitting up at 1 in the morning, refreshing the bank app. Probably someone in your time zone. Probably tonight. Munger was not a psychologist. That is the first thing to put on the table. He was a lawyer who became Warren Buffett's business partner at Berkshire Hathaway, and he spent 40 years watching a particular kind of disaster unfold at close range. The disaster was a smart investor, usually with 3 degrees and a successful career, making the same 5 errors over and over and going broke. Munger kept a list. By the time he gave the speech in 1995, the list had 24 tendencies. By the time the speech was printed in 2005, he had added a 25th. So when you hear the number 25, that is the print version. The original spoken version had 24. The substance is the same. 11 years before Munger gave the speech, a Stanford psychology professor named Robert Cialdini had already named most of the same tendencies in academic language. His book is called Influence, originally 1984, expanded edition 2021. Cialdini named them first. Munger named them in dollars. The academic version sat on 100 psychology shelves. The Munger version sat in the head of every investor who survived the dot-com crash, the 2008 crash, and the 2020 COVID crash. One quick disclaimer before we go further. This is education, not financial advice. If your portfolio is taking your sleep, please talk to a fiduciary. What follows is a frame, not a recommendation. We are going to call this architecture the 5 misjudgments. 5 errors. 1 brain. The 5 misjudgments is not a complete map of Munger's 25. It is the 5 that, by his own count, and by 30 years of behavioral economics, cost investors more money than the other 20 combined. Reward and punishment. Liking and loving. Doubt-Avoidance. Inconsistency-Avoidance. Social proof. We are going to walk all 5. If at the end of this it feels less like a flaw in your wiring and more like a map you can run, you do not have to do anything. You will already be on the other side of it. If this is landing, here is the deal. Subscribe to the channel. We do one of these every week. Frameworks like this one. Patient, evidence-based, useful in the next decision you make, not in 5 years. Subscribe and they show up in your feed when they ship. That is the only way the channel finds you again. Before we go into the 5 errors, do one thing. Pull up your portfolio. Pick one position you have held for more than 2 years. Hold the name of that position in your head as we walk the 5. By minute 15, you will know which of the 5 errors is keeping you in it. Error 1. Reward and punishment super response. Munger called this the most powerful tendency he had ever identified. Show me the incentive, and I will show you the outcome. The brain follows incentives in ways the brain does not see. Here is the form it takes in your portfolio. Your broker makes money when you trade. Not when you make money. When you trade. The free trade is not free. There is a 0.6% spread on the bid-ask. And the broker collects it whether the trade was a good one or a bad one. The mutual fund manager you trust gets paid a 12b1 fee that is collected from your account every year, regardless of performance. The advisor who shows you the chart at the meeting is paid a percentage of assets under management. The more you put in, the more they make. The longer you keep it in, the more they make. Their reward is your bandwidth, not your return. Munger said it in one line in 1995. Whose bread I eat, his song I sing. Detection cue for error 1. If your broker, advisor, or fund manager makes money, when you make money, you are aligned. If they make money when you trade, rebalance, or stay invested regardless of performance, you are running error 1. Error 2. Liking and loving. The brain bonds with the people and companies it admires, then refuses to see their flaws. This one is the warmest of the 5 errors, and the most expensive. The form it takes in your portfolio. The stock of the company you love. The founder you idolize. The advisor who has been your advisor since the year you started saving. The fund manager who had a great 2007, and you have ridden them through 2008, 2016, 2020, and they are still in your account because you would feel disloyal selling. Liking and loving was the first tendency Cialdini named in his 1984 book, 11 years before Munger named it in dollars. The cost is real. A 2023 Vanguard study found that investors who stayed in a single fund for more than 10 years, out of a sense of loyalty, underperformed by 0.7% annually, versus investors who rebalanced based on performance. 0.7% compounded over 30 years is roughly 1/5 of your portfolio. Detection cue for error 2. If you cannot list 3 legitimate flaws of the stock, the manager, or the advisor you would not sell tomorrow if you owned them fresh, you are running error 2. Error 3. Doubt-Avoidance. The brain hates ambiguity. Faced with a question it cannot resolve, the brain will reach for the fastest answer that ends the discomfort, even if the answer is wrong. Munger named this the engine behind the COVID crash sell. March 2020. The S&P drops 34% in 23 trading days. The investor opens the brokerage app. The question is, what should I do now? The brain cannot answer. The discomfort is unbearable. The brain reaches for the fastest available action that ends the discomfort. Sell. Then it spends the next 18 months watching the market climb back and beyond. The decision was not bad. The decision was fast. Doubt avoidance does not look like panic from the inside. It looks like clarity. That is the trick. The form it takes when the markets are calm is even more expensive. The advisor calls with a recommendation. You do not understand it. The doubt avoidance brain says, just say yes. Yes ends the question. No requires another conversation. Yes is the cheapest exit, in the moment, from the discomfort of not understanding. Detection cue for error 3. If you made the last big move because you were certain, fine. If you made it because you were uncomfortable not deciding, you were running error 3. Error 4. Inconsistency-Avoidance. Munger called this the tendency the brain has to refuse to admit a previous decision was wrong. The brain conserves what Munger called programming space by being reluctant to change. Once you have made a decision, the brain wants to defend it. The form it takes in your portfolio is sunk cost meets ego. You bought the stock at $50. It is now at $20. The thesis is broken. Selling means admitting the buy was wrong. Holding means the loss is not real yet. The brain prefers the second framing, even though the first one is true. So you hold. And the loss compounds. The deeper version of the error is doubling down, adding to the losing position to average down. Buying more at 20 so the cost basis comes down to 35. This is the brain doing math the brain wants to do, not the math the position deserves. The Vanguard data on this is brutal. Investors who add to losing positions underperform by an average of 1.8% annually, relative to investors who close the position when the thesis breaks. The brain that wants to be right yesterday is robbing the portfolio that has to be right tomorrow. Detection cue for error 4. Are you holding a position because the thesis is still strong? Or because admitting the buy was wrong feels worse than the loss? Error 5. Social proof. The brain trusts the herd more than its own analysis. This is the most replicated tendency in all of behavioral economics. Cialdini named it in 1984. Munger named it in dollars in 1995. 30 years of behavioral finance papers have confirmed it across every market, every asset class, every decade. The form it takes is the meme stock. The crypto chart that everyone is posting. The financial influencer your friend texted you about at 11 at night. The 45% of your S&P 500 index that is now sitting in 7 names, because everyone else is sitting in those same 7 names, and you are rebalancing into the same concentration without seeing it. In 2025, a research team at the National Bureau of Economic Research, named Goldsmith Pinkham and colleagues, looked at 20 years of retail trading data across 2 million accounts. They found that retail investor returns track the social proof signal more strongly than they track the underlying fundamentals. By a wide margin. The social proof brain is a real-time pricing mechanism. It is not yours. It is the herd's. And the herd is wrong on the way up just as often as on the way down. Detection cue for error 5. If you bought because you understood the company, fine. If you bought because the chart was on every feed thumbnail you scrolled past for a week, you were running error 5. So here is the 5 misjudgments, fully named. Reward and punishment. Liking and loving. Doubt-Avoidance. Inconsistency-Avoidance. Social proof. Reward and punishment says, your broker, advisor, or fund manager is following the incentive their compensation creates, not the one your portfolio needs. Liking and loving says, the stock or the manager you would not sell tomorrow if you owned them fresh is the one most likely to cost you 0.7% compounded annually. Doubt-Avoidance says, the decision you made because the discomfort of not deciding was unbearable was not a decision. It was an exit. Inconsistency-Avoidance says, the loser you are still holding because admitting the buy was wrong feels worse than the loss is the one robbing the portfolio that has to be right tomorrow. Social proof says, the chart everyone is posting is not your analysis. It is the herd's. And the herd is wrong on the way up, just as often as on the way down. 5 errors. 1 brain. Munger named 25. These are the 5 that, by his own count and by 30 years of evidence, cost investors more money than the other 20 combined. If you have walked with us through the Munger 3 bucket, you already have the shape of this. 3 bucket was Munger's framework for what to do with the money. The 5 misjudgments is Munger's framework for what stops you from doing it. Same Munger instinct. Same 40 years of watching smart investors blow themselves up. The architecture is the same. The error is just upstream of the action. Here is the line. Say it once with me, even if only in the kitchen. You are not bad at investing. You are running a brain that was optimized for the savannah, not the brokerage. Munger's 5 misjudgments are the 5 places the brain trips first. 5 errors. 1 brain. The map is the start of the cure. 5 diagnostic questions before we leave the takeaway. Question 1. Does my broker make money when I make money or when I trade? If the second, that is reward and punishment. Question 2. Could I sell a stock I love today? If no, that is liking and loving. Question 3. Did I make my last big move because I was sure, or because I was uncomfortable? If the second, that is doubt-avoidance. Question 4. Am I holding a loser because the loss feels less painful than admitting the buy was wrong? If yes, that is inconsistency-avoidance. Question 5. Did I buy because the analysis was strong, or because everyone else was buying? If the second, that is social proof. 5 answers. Your map. Not a story about being bad with money. A story about a brain that has not been updated in 40,000 years and is now being asked to make decisions in a millisecond market. 3 install practices. Pick one tonight. The first is the 24-hour rule. No trade decision the same day the news arrives. The buy or sell button waits 24 hours. The brain that wants to trade now is usually the brain running one of the 5 misjudgments. 24 hours later, most of those trades you are going to make will look obviously wrong. The second is the loss letter. When a position is down 30%, write a letter to yourself. I bought this on this date because of this thesis. The thesis is now still valid, or it is broken. I am keeping or selling because. Then read it the next morning. If it does not survive a sober reread, sell. The third is the anti-mirror. Once a quarter, write down the consensus position on the loudest stock you own. Then write the strongest argument against it. If you cannot write the against argument, you do not own the stock. The stock owns you. Pick the one that is closest to the door tonight. That is the Munger map. Reward and punishment. Liking and loving. Doubt avoidance. Inconsistency avoidance. Social proof. 5 errors. 1 brain. The math is going to keep moving. The headlines are going to keep arriving. The broker is going to keep calling. None of that has changed in 30 years. What changed is that you now have the map. So here is the one thing to do tonight. Not next week. Tonight. Open a notebook or the Notes app on a different device than your brokerage app and write 1 sentence. The next trade I am planning to make is, and finish the sentence. Then put the notebook on the kitchen counter. Tomorrow morning, before you open the brokerage app, read it again. Most of those trades you were going to make will not survive the night. That is the test. And in the comments, 3 words. The error you ran most this year. Mine, when I lived it, was the loving. The stock I had owned for 7 years that became part of the family. The thesis I refused to reread. Whatever it is, write it down once tonight. The page might want it. Subscribe for the Calm Investor Playbook that turns volatility into compounding. Calm investors. Build wealth with patience, not panic.